Good evening, everybody. Thank you for joining us here in this edition of the monthly market insight. I think we discussed last month about the early signs of a second wave in India. And unfortunately, it has been a very painful month for many of us. I'm sure for all of us, friends, family members, colleagues at the workplace, neighbors, none of us have been spared from the deep misery and tragedy that has been playing out. This is a very difficult time for all of us, and the only hope remains that the vaccination campaign continues at a rapid pace, and all of us continue to, practice safe protocols. I wish and I pray for good health for all of you and for all citizens of the country, and frankly, good health for everybody across the world. But this is the monthly market edition, and therefore, once again, we'll take a look at what we think are some of the key issues, and try to provide you with some food for thought, which can help you think better about perhaps some of the issues that are of concern to you, that you may be thinking about. And of course, we'll take a look at all the normal indicators that we do on this conversation that we have. So without any further ado, we'll proceed as we normally do. I'll just pull up the presentation on the screen. That will help us sort of focus the discussion. I hope the file is up there and now visible on the screen. And what will we be talking about today? This is what we are going to talk about today. In a way, some of these issues perhaps have been talked about even in past months, but today we are almost 15 months into the start of this pandemic, or at least the recognition that this is something very unusual. And this word pandemic has come to denote something that we are now living through, and not just a word which was in the dictionary. So we are going to discuss the fiscal and monetary policies that we've seen across the world. We'll take a slight diversion to talk about India's unicorns, which I think is an interesting longer-term trend, nothing to do with today's market. And then eventually we'll talk about equity market takeaways, and where do we see earnings and valuation at the current point of time. So moving on to the first topic, which is really the global fiscal deficit. All of you are aware that every year in India, and of course, recently the budget gets presented on the 1st of February. And that's the time all of us really discuss the fiscal deficit. But this data that you see here, if you look at the left-hand side, is a track of the global fiscal deficit all the way from 2002 till 2020. And this is for the global economy. The countries that are covered here account for approximately about 80% of total GDP. So if you look at this chart, what you will see is that in 2020, in a response to the pandemic, and this started pretty much from March of 2020, there was a dramatic expansion in the global fiscal deficit. So from 3% of GDP, it went up sharply to almost 10% of global GDP. So in response to the pandemic, in a response to the lockdown, governments thought it necessary to make certain fiscal transfers to citizens and businesses to help them get through the pandemic. Of course, tax revenues also came down for many governments across the world. And as a result, the fiscal deficit ballooned from 3% to 10%. If you look at that chart on the left-hand side, what you will see is also the previous time that we saw a significant expansion, which happened during the global financial crisis in 2008. There was an expansion in the global fiscal deficit from 2% of GDP to 6%. But this time around, the increase in the deficit is far more dramatic, 3% to 10%. If you look at the chart on the right-hand side, this actually compares the fiscal deficit of advanced economies, or AEs as it is called over there, and the trend in fiscal deficit of the emerging and developing economies. So the light bars are the advanced economies, and the gray bars are the emerging and developing economies. As you can see over there, the dramatic increase in the fiscal deficit actually happened in the advanced economies, led from the front by the United States, but significant contributions to this expansion also happening in Europe and also in Japan. Emerging and developed economies did see an increase in their fiscal deficit, but this went up only from about little over 4% of GDP to less than 7% of GDP. The dramatic expansion took place actually in the advanced economies, where it went from 3% of GDP to almost 12.5% of GDP. In fact, if you take the US as an example, we talked about this last month, in the space of about 15 to 16 months, the total fiscal support that they have announced to their economy now is in the region of about 30% of GDP. So that is how aggressive the fiscal response has actually been. Now, what has this kind of fiscal policy done? It has supported citizens and businesses by transferring money to them, by giving them breaks. And it has given the equity markets confidence that governments are supporting the economy during a difficult time, and therefore it will allow the markets to navigate a period where it is dependent on government support, but going forward, hopefully it becomes more self-sustaining. It was not just about the fiscal support. As all of you are aware, there was also a very significant monetary policy support which was extended to the economy. In fact, I would say that this was unprecedented monetary expansion. What do we mean by monetary expansion? This is basically the money put into the system by the central bank, whether it is the US Federal Reserve, the RBI, or the European Central Bank, or the Bank of Japan. This is the pace at which they bought assets from the market, literally printed money and put it there into the system. And you can see those charts over here where we are tracking what we call money supply growth. These are the preferred money supply indicators for each of these large economies. And you can see the US M2 growth from March 2020 spiking significantly higher to levels which have not been seen at all in the last 60 years of US history. Similarly, if you look at Europe, a similar spike. Of course, Europe did see significant monetary expansion in 2008, and this has more or less matched that. US, of course, completely blew out relative to previous monetary policy support. The same thing is visible in Japan as well, where this is the highest degree of monetary policy support or money supply growth which the central bank has permitted since almost the late 80s or 90s. The only large economy where actually monetary policy did not support significant M2 growth was China. But China, as we all know, very unique case. The virus started there, but somehow they seem to have been least impacted, and neither have they responded with very strong fiscal or monetary policies. But across the board, all the other large economies have dramatically increased money supply. Now, when you increase money supply, what does this do? Once again, it makes money available to people, it makes credit available to people, and gives them the ability to navigate this difficult period where economic activity is impacted. But what it also does is that it tends to depress the value of paper currencies and tends to increase the value of commodities like gold, or for that matter, as we've seen in recent times, the value of metals or even food prices, and we'll talk more about that later. But what I wanted to really highlight today is perhaps one of the unintended consequences of this kind of money printing, because the money eventually has to go somewhere, and it is increasingly visible to us that the place where the money has actually gone in very dramatically is in the cryptocurrency market. We don't normally discuss the cryptocurrency market. We stick to discussing equities. I have no views to offer on cryptocurrency, but all I wanted to do here is show you what a dramatic increase in value has taken place in the cryptocurrency market. If you look at the left-hand side, a chart, the red and blue chart, in early 2020, the total value of cryptocurrency assets in the world was about $300 billion. The red line is Bitcoin and the blue line is ETH. And this is actually not a cumulative number. From $300 trillion, the cumulative value of these two asset classes has now crossed $1.5 trillion. Right? So this is an unbelievable expansion of value, which has literally happened in the last 1 year, which has been supported by this kind of money supply. Because remember, this money is now being offered at 0% cost, right? Because most of the large advanced economies, the policy rate is almost set at zero at this point of time. And when you have a zero policy rate setting, it tends to, as I said, support physical assets. But this time, we also have these cryptocurrency assets, and these are the ones which have benefited the most. Typically, you would expect gold to benefit from 0% cost of money. Yes, gold has done well, but the availability of cryptocurrency this time around has caused the value of that asset to multiply dramatically. If you look at the right-hand side, which is the Bloomberg Cryptocurrency Monitor, and you add all the cryptocurrency assets in the world today, the value is now $2.5 trillion as of day before yesterday, which means from literally $250 billion, you have multiplied the value of cryptocurrency assets by a factor of 10 in 1 year. Just remember, $2.5 trillion is the value of all equities in India. And this is value which has been created by companies which have been in operation over many, many years based on the cash flow that they have created. Here, an asset which does not generate any cash flow intrinsically has seen its value go from 300 billion to 2.5 trillion in literally 1 year period. And this is perhaps the unintended, I don't know if it is intended, unintended consequence of the loose money policies being pursued, particularly in the developed world. I'm not saying this is a bubble, but it is highly unusual to see this kind of value getting created. And we are no longer talking of fringe asset, because $2.5 trillion is now a very significant value to the whole world. If anybody is interested, the total value of gold in the world today, held whether it is by individual central banks, funds, as investments, is only about $9 trillion, $9.5 trillion. So just imagine, compared to that $9 trillion total value of gold in the world, you have created this cryptocurrency asset at 2.5 trillion. And remember, most of the gold is owned personally. It's in the form of jewelry. If you actually take what we believe is the value of only the investment holdings of gold, it is maybe 35 to 40% of the total gold assets, which is only about $3.5 trillion. Compared to that, we now have this cryptocurrency asset, which has gone up to $2.5 trillion. But this is, in some senses, also a potential risk at some point of time to the financial system, because all of this is backed by 0% cost of capital. And if cost of capital starts to go up, these asset classes could start to face pressure, because intrinsically, they do not generate any cash flow. So this is a bit of an aside. Yes, we have supported the global economy. We have supported asset prices and equity markets with dramatic fiscal policy intervention and monetary policy intervention. But I do believe that increasingly there is a risk that this unintended consequence is creating a significant amount of value, and this could create some financial risk somewhere down the road. We don't know when. So that's about the broad perspective of global fiscal and monetary policy. Moving on from that, just take a slight diversion into another topic, which is more in an India context, which is the unicorns. The reason I thought this is interesting to share is that, unlike in the past in India, where most companies used to depend on the public markets to raise money, we now have a situation where companies are able to get funded in the PE market, and now they are coming to the market with an IPO. The company that you see over there on the slide, Zomato, as you would know, has just filed its DRHP and plans to go public, may well go public in the next month or two, which, as per the reports, potentially could be looking to raise upwards of close to $1 billion through the IPO process. So what are unicorns? Unicorns are these companies typically funded by private equity, unlisted companies which are now having a market value of more than 1 billion. In the past, we never had so many such companies in India. This is a very interesting study done by Credit Suisse, which puts the numbers in context. On the left hand side, you can see the trend in terms of equity fundraising, both private and public. Typically, as I mentioned in India, if you go back to the period up to maybe the mid 2000s, fundraising was dominated by the public market. There was not much of a private market for equity fundraising, the PE funds, the venture capital funds, the seed capital funds. But today, they are a reality. And as you can see in that chart, over the last decade, private fundraising by companies has actually exceeded the amount of capital raised through public offerings to the public. And the companies are spread across multiple sectors. If you look at the right hand side, this report by Credit Suisse says that India now has 100 unicorns, which means 100 companies with a market cap of more than 1 billion based on their last fundraisers. And the total value of these companies put together is now $240 billion. And on the right side, you can see that these companies are very well distributed across multiple sectors. Why is this interesting? For two reasons. It means that no longer are companies only going to be created by people whose surname starts with Tata, Birla, or Ambani, or an Adani, but companies can also get created by individual entrepreneurs and professionals with the backing of the money which is now available to them from the private equity and the venture capital funds, rather than relying on just the family money. And when we talk about the growth of the capital market in India, we need to focus not just on the money that investors are giving to us as fund managers to invest in equities, but it is equally important that we get supply of quality companies on the other side who can then absorb the capital which is coming in. So I believe this is a very healthy trend for the long term, where more and more money is getting raised privately to fund companies. And then when those companies have some proof of a viable business model, they are able to come to the market and then get listed. As you would know, we already do have a few such companies listed in the market. Companies like InfoEdge or India Mart Nivesh, or you have Intermesh, you have a company like Nazara Technologies, which went public recently. And then, as I said, of course, you'll have Zomato, perhaps in the near future, but many more companies are going to come, because eventually these companies which were funded by private equity and venture capital will look for an exit in the public market. But I believe this is very healthy for the growth of the country, where you are democratizing the access to capital. Everybody has a genuine chance to become an entrepreneur, and no longer is it driven just by the family name. This just gives you the sense of the rapid transformation which is taking place. Just look at that right side chart. 87% of the BSE 500 started before the year 2000. 16% are companies that started before 1950. 20% of the companies started between 1950 and 1975. What does this tell you? These are all the companies which were typically, in many cases, old money coming from the old business houses. But when you think of these unicorns, which are these 100 companies with potential market cap of more than $1 billion based on their private market value, these are all very young companies. 2/3 of them, as you can see on the left-hand side, started after 2005. So again, as I said, this is a very good and encouraging development, both for the growth of the country and for the maturity of our capital markets, because it is providing a pipeline of high quality companies into which we will be able to invest. And it is a democratization of the access to capital, where we can have more and more successful entrepreneurs and no longer limited just by their family name. Moving on from that, let's come back to focus quickly on where we are in terms of the markets and a quick summary of everything that we've been discussing. Very little has changed on this slide. The rollout of the vaccine certainly is continuing to give support to the markets. To those who are not aware, for example, in the US, 50% of all adults have now received at least one shot of the vaccine. More than 40% have received both shots of the vaccine. And the US president has set a target that by July 4th, Their target is that all willing adults in the US would have received both their vaccine shots. So this is an incredible development taking place in a very short period of time and important to the world economy because the US economy is almost about 27% of global GDP. And what we are effectively saying is that the country will be pretty much fully vaccinated by the time we get to July 4th, which is now less than 2 months away. That's a big engine of the global economy. The good news, the second largest global economy in the world, which is China, again, very strange, home of where the virus was initially found, but somehow it has not had a major problem in recent times with that. That's about 16-17% of global GDP. So 40% of global GDP is now in two countries which look to have broken free from the pandemic related crisis. Europe, much slower, but based on their own vaccination rates, I do believe that by October, November, based on the current run rate, they would also have significantly vaccinated their population. There's a big difference in Europe between countries, and if you still consider UK as part of the vaccine, part of Europe, then UK would actually reach almost a 90% rate of vaccination very shortly, perhaps within the next few weeks. So a large part of the world is now getting vaccinated in terms of its importance to global GDP. That gives markets some degree of confidence along with fiscal and monetary support that we have already talked about. One of the unintended consequences, or perhaps a very likely consequence, I should not have called it unintended, is the fact that when you create so much liquidity, there has been a very sharp surge in global prices for metals and for food. In fact, if you look at the FAO's food index, it is now up 70% from the low point in the middle of 2020. And in fact, it is now reaching some of the peak prices we have seen for food in 2012, 2013. And this is likely to impact inflation expectations. We've already talked about the reforms undertaken in India over the past year. Yes, we have had a supportive fiscal stance, but as any other emerging market, as we saw in one of the first slides, it has not been as aggressive because we don't really have the resources to be so aggressive, but it is supportive, and that is what is the best we can hope for. The Monetary Policy Committee and RBI maintaining an accommodative stance, doing what they can. But I do think that increasingly the surge in metal and food prices is going to impact inflation. The good news so far, oil prices have not moved up, but if they also start to move up, I think it will create problems for all central banks, not just for India, because then they will have to really balance between their desire to be growth supportive and start to worry about the challenges on inflation, given that all these commodity prices are going up sharply. We have already talked in the past about how companies that navigate a challenging period can very often accelerate growth, gain market share and profitability as you exit the crisis. Why? Because they have lesser competition, right? And what we've seen in India cumulatively over a 3 to 4 year period, demonetization, GST, NBFC crisis, COVID pandemic, the informal sector, the unorganized sector has suffered. Those benefits have gone to the formal sector, and listed companies are by definition formal sector. Less competition for them, they have been able to gain market share. Less competition, they have been able to exercise pricing power. Profitability has been very strong. 2020 to 2022, GDP of India likely to go up by only about 2 to 3% because in 21 it comes down, then it starts to recover in 22. But when you look at earnings for the Nifty 50, over that 2 year period, earnings are expected, it's a forecast of course, but expected to go up by 40%. Even in 2021, a year in which GDP is down, remember, Nifty 50 earnings are actually expected to go up by about 7 or 8%. The risks, elevated valuations are elevated. We'll see some charts. And this makes the markets vulnerable to shifts in global liquidity, inflation expectations, and of course, the resurgence of COVID-19 in India. What impact is COVID-19 resurgence having? We can take a look at the impact of the second wave in the next two slides. This is a tracker of the recovery in India. It's indexed to 100 in January 2020. You can see that when the lockdown happens in April 2020, March, April 2020, activity level collapses. Then as we start to unlock, activity levels pick up. It recovers to above the level of 100 in February and March. Remember, we had record levels of GST collection getting reported for March. And then as the second wave starts to hit, you start to see activity levels come down. Of course, there is also a seasonal impact. Typically, April has lower activity. But I think once we get the data for May, what we are likely to see is that that index has continued to decline because there are localized lockdown across multiple states in India. It is not as extreme as it was a year ago, but companies are getting impacted, right? So even in recent days, when companies have announced results, you look at Reliance Retail or DMart, they have indicated that 70 to 80% of the stores are affected by local restrictions. Maruti is saying that 75% of the dealerships which were operational in March now are not operational because of local rules or just customers not showing up. And they've in fact taken a 15 or 20-day production shutdown. They would have normally taken their annual maintenance in June, but this year they brought it forward and did it in May to sort of combine it with the fact that anyway the country is going through a lockdown. So to cut a long story short, activity levels are coming down in the economy because of the second wave, as we are all well aware. Uh, Daily e-way bill generation, again, basically tracking the recovery. As you can see from the peak in March, it started to come down. I think by the time we get the data for May 15th, it is likely to be even lower than that, just based on the anecdotal conversations we are having with companies. So yes, there is some impact in this numbers. I do expect that the GDP growth estimates that people have of 11-12% will see a cut. But the good news is, as we are seeing, let's say in the city of Mumbai, from a peak of 10 to 11,000 infections a day, the new cases have now dropped by about 70 to 80%. Last few days is closer to 2,000, 2,500 cases a day. In fact, yesterday was below 2,000 a day. What it means is that we are starting to get some control on the second wave. Different states are at different points in this curve, but it does give you some hope that over the next month or so, gradually you can start to see an uptick in activity being allowed by the government, hopefully, as the situation improves in individual states. What is the current forecast for earnings? We look at this slide every time. Nothing much has changed. Look at the right side. March 21 estimate 9% growth in EPS for the Nifty 50 compared to a decline in GDP of about 7 or 8%. And then next year, when GDP is expected to rebound, as I said, currently by 11%, but I think those estimates will be cut. Earnings estimated to grow by 38%. Very likely that these estimates will also see some cuts because of the slowdown in activity that we've seen in the last month. But as long as it is only a month period, it should not have a dramatic impact on the overall earnings forecast for the year. Still likely to be a good positive year for earnings. Where are we in terms of valuations? Let's just fast forward to the forward P. Now we are looking at perhaps a more normalized level of activity, though some impact of this month will be there. What is the valuation telling you? You are now in the expensive territory. The yellow line is the long-term average. The red line is one standard deviation above, and we are now above the red line. So this is expensive territory. Yes, you can argue that when you break up the market, some component is cheap, some component is expensive. But again, when you look at the market aggregate, it gives you some sign of whether markets are cheap or expensive. Just like when you see the same chart, you can see in April 2020, it published and said, look, market is extremely cheap. This is a good time to raise allocations to equity. Unfortunately, that situation is no longer visible when you look at this top level data, which is telling you that equities are now in the expensive territory. Even in March 20, when equities were very cheap at an aggregate level, there were some companies which were expensive, some companies which are cheap. So bottom up, you could get a different perspective, but there is a message that you get from aggregate valuations, and this is the message that we are getting today. We can also look at the price to book on the left-hand side of the Nifty, and as you can see, from record low valuations in March 20, we have now rebounded into expensive territory. Yes, little bit of nervousness because of the second wave, but you have to say that now there is no real significant drop from the recent high in terms of the trailing price to book ratio. Markets remain in expensive territory. If you then look at the price to book ratios of the mid cap and the small cap. That's on the next slide. Interestingly, the Nifty mid cap index still not showing up in the expensive territory. It's still slightly below the red line. I think this is partly the impact of some changes which have taken place. But broadly speaking, when you compare it to the large cap index, there is a slight net marginal attractiveness of the index, but again, it's not really in cheap territory, perhaps in the upper ranges of fairly valued. You look at the Nifty small cap 250 on the right side. Here, of course, it has completely broken out into expensive territory. But I must add that this is also a function of many new listings which have happened, particularly over the last year and a half. Many of them are small cap companies. But again, broad message we are getting from valuations is that expensive. Within that, mid caps may be still slightly more in the fair value zone, but in general, not much to choose between the valuations. One final slide, because it's one thing to talk about where are equities, are they expensive? The other way to look at it is that how expensive are equities or how cheap are equities compared to bonds. And that is what we see over here. Now, if you look at this, we are actually still at parity relative to bonds. Why do I say that? The 10-year average yield difference between the Nifty 50 and bonds is 99 basis points, negative 99 basis points, that yellow line. The current yield difference is 1%. So that tells you that yes, equities are expensive relative to their own history, as we saw in the PE and price to book charts. But when you compare it to bonds, the reading is more neutral. It is not showing very expensive. If you look at that chart, you will see that, in early 2018, equities were far more expensive relative to bonds. So today we are actually at a point where we are sort of in neutral territory. So it's good to look at valuations in different ways. One is relative to history. One is relative to the alternate asset class. This is giving you a slightly more neutral reading towards equities. So, these are some of the big thoughts we wanted to share with you. The impact of the fiscal policy and monetary policy support to the markets, how economic activity in India has shaped up in the last month. There are certainly some stumbles. There is risk to estimates. Valuations are elevated relative to their own history. Relative to bonds, it's more in the neutral territory. There is some risk to financial markets from inflation expectations because of the surge in metal prices, food prices. Thankfully, oil prices have stayed muted. And in general, we should be aware that this kind of wild value creation, which is happening in cryptocurrency, could prove to create challenges for financial markets, not the real economy, but for financial markets somewhere down the road, because the absolute value is now a very big number, $2.5 trillion of value in cryptocurrency assets. So that's about it for today in terms of the presentation. I'll halt over here, and we can, as usual, move into Q&A mode. We've received a lot of questions, and thank you for sending those questions in. And I'll request my colleague Niranjan to he's sort of screened and combined some of the similar questions, so he'll now start taking those questions one by one.
Yeah, sure. Thanks, Vetri. It was a detailed overview on today's topical subjects. Yes, we have a pile of questions received for today's session, which have come to us over the last couple of days, and it continues to come in as we speak. Participants, please keep them coming. We will take as many as possible in next 30-35 minutes. First question for the evening. Vetri, you mentioned in your deliberation that there is a large difference in economic support received in terms of fiscal as well as monetary between the two sets of nation, that is the advanced economies and the emerging economies. So do you expect the growth path to be divergent in these two set of nations? And how is it likely to have an impact on India related to emerging economies on growth and also in dollar terms? So this is a question which is coming from a couple of people. So, yeah.
So very good question, Niranjan. And I think we have to combine two issues here. One is that without doubt, the extent of support which has been provided, both monetary and fiscal policy. And in fact, in the US, they are continuing to announce new policies, right? We just got an announcement last month about the $1.9 trillion infrastructure related package. They're already discussing another $1 trillion package to, address certain other issues. Uh, so when you look at it from that perspective, I think clearly the level of support in these advanced economies unprecedented. You have to be optimistic that their growth rates are likely to start to recover, particularly when you combine it with the fact that their vaccination rates are picking up so very dramatically. I think this is eventually good news in a sense for emerging economies. We are constrained. We do not have the ability to support the economy so dramatically, but the heavy lifting being done by these developed economies will eventually benefit us because their demand for goods and services is likely to remain strong, particularly as they get the benefits of being able to re-engage with normal economic activity because of vaccination, and those benefits are likely to flow into emerging economies which are producers of the goods and services which are in demand over there. So I think we will benefit, but of course, eventually, the outcomes for emerging economies will be determined by how well their own economies were to sort of revive. But to the extent that, let's say for India, if you look at exports of goods and services, about 21 to 22% of our GDP comes from exports of goods and services. So if that starts to do very well, it gives a lift to the economy. The bigger part of our economy is domestic. So we do need that to recover, but that 20% will provide positive support. And, there are other emerging economies for which the exports of goods and services may be 30, 40, 45% of GDP. So they will tend to benefit even more. Particularly, commodity exporting countries will benefit simply because commodity prices have gone through the roof. India is not a very large commodity dominated economy. It gives us more stability over the longer period. But, Brazil, Russia, these are typically the commodity heavy. South Africa, very commodity driven economies. They will tend to benefit disproportionately from this cheap money and strength in commodity prices.
Yeah, thanks, Vetri. Just a follow-up question coming from Mr. Pradeep. So, you think this is going to have a neutral impact on dollar in terms of dollar for India?
So let's leave aside the movement of the rupee versus the dollar because that has other elements built into it. But in general, this kind of monetary and fiscal support that the US is resorting to eventually should lead to a much weaker dollar. Whether that translates into a stronger rupee is harder to figure out. Simply because there are many other elements of competitiveness of our exports, our ability to tackle inflation, which will all become relevant in that argument of how does the rupee behave relative to the dollar. But if you were to see the DXY, which is the dollar vis-a-vis all global currencies, I would tend to believe that the dollar is likely to remain weak. Of course, that will certainly support the Indian currency in terms of its relative strength. But I do think that the RBI as well is now very aware that keeping the rupee strong actually does not help India's exports. So I expect the rupee will also benefit from the dollar weakness in terms of strength, but it is unlikely to be among the stronger currencies. You would expect currencies of the commodity denominated economies like Brazil, Russia, South Africa, and there are quite a few other emerging economies. Those currencies will be much stronger relative to the dollar. India's case is actually slightly more balanced.
Sure, Vetri, thanks. Yeah, you talked about cryptocurrency. There are a few people like Vaipinkara, Somanath, Bahubali Shah, asking questions on this subject. So, is there another bubble in the queue when this asset is not supported by any physical asset class? And second question is, how will it have any impact on financial markets and mutual fund industry?
Sure. So good question. And it goes back to the nature of these cryptocurrency assets. I would actually not distinguish between what I would call cryptocurrency assets and let's say very simplistically gold. Reason being that neither of these two assets creates its own cash flow, right? If you buy a equity, a company generates free cash flow every year. It will give some of it as dividend. It will use some of the cash flow to reinvest. And therefore, It's an asset which generates cash flow. Gold does not generate cash flow. There is a cost attached to owning it. Similarly, cryptocurrency does not generate any cash flow of its own. There is a cost attached to owning it. So it's very similar to gold in that sense. Now, this is a problem because an asset which intrinsically generates cash flow can absorb a increase in the cost of capital, whereas an asset which does not create cash flow of its own, when the opportunity cost is zero, because cost of capital is zero, there is no problem. But when the cost of capital starts to go up, these assets which don't generate cash flow tend to struggle because they don't have their own intrinsic cash flow generating capability. I will not use the word bubble because we don't know, right? I mean, it has become $2.5 trillion. Who knows? It may become $5 trillion. But without doubt, this is a risk because you have created this asset class which has gone from being a small, pocket of the global economy to literally now being an asset class which is bigger than the market cap of India. Right, so you start doing a global arrangement of market caps, and you suddenly realize that cryptocurrency has come into that ranking, and it's maybe among the top 10, countries in the world in terms of its market cap. So that certainly creates financial risk because there are asset owners of this as an investment today, and a collapse in the value or even a sharp drop in the value of that asset. We have seen this in the past as well, right? During the global financial crisis, during the dot-com crisis, when one part of the financial market experiences stress, the stress translates into the rest of the financial market because people have losses in this asset class. They start taking actions in the other asset class to balance their portfolio. It may not affect the real economy. We saw this during the dot-com crisis, right? In the dot-com crisis, only the values of those dot-com companies went up. When they collapsed, financial markets got impacted, but the real economy did not really get impacted to that extent. So to my sense, cryptocurrency again if they were to unwind in a very disorderly fashion, it will have an impact on financial markets, not necessarily on the real economy.
Yeah, thanks, Vetri. In fact, that assures a lot. So, in fact, it says that why one should be looking at asset which is more stable. Yeah, thanks. And there is one question on the market pulse. So, the question is like this: the second wave of COVID has gripped India fast and has forced many states to go into these semi-lockdown in April and also extended to May month as well. So, do you think the market could undergo further consolidation, or do you think the market is underreacting to the COVID-19 situation? Can you explain?
So I don't have any answer to provide on this. One reason is very simple. It's very hard to understand what the market does in the short to medium term. Over the longer term, equity markets are slaves to earnings. We know that the data supports that view. But what the market does over 1 week, 2 weeks, 1 month, 3 months is, always going to be a surprise to us. It's impossible to predict. In 25 years of being in the market, I've figured that's impossible to figure out. Very specifically, if you're the question relating to our markets underreacting to COVID-19, I'll give you a very simple thought process here. We are not the first country to experience a second wave, right? It's happened in the US. There are countries in Europe who have second wave, they've had third wave. Now, when you go and look at the data for all these countries, the data is what it is. The data is telling you that in some cases, the market ignored the second wave, it ignored the third wave, it has continued rising in those countries. So I'm not trying to give you an explanation. I can only show you the data, which tells you that in economies which experienced a second wave and a third wave, the equity markets in those countries also didn't respond. So I cannot give you a reason for why it did not respond, but that is what happened. And when I look at that, I look at India and I say, I don't know why it is happening, but perhaps it has happened elsewhere. Same is happening here as well. I don't have a better answer than that.
Sure, Vetri, thanks. There are more questions actually coming on economy and also on cryptocurrency, but due to paucity of time, I will move to the next subject. So I'll take one or two questions on the sectors. This question is coming from Deepak Kumar Naskar. So which sector will be back in focus amid the current lockdown-like scenario? Which sector will get impacted the most from the second wave and why?
So I would just want to say that, we are not trying to invest based on what we think will be beneficiary of this wave or what will suffer from this wave. I think we have talked about this earlier. Our view is that, and as I mentioned earlier, companies' values are eventually determined by the cash flows that they generate over 10 years, 20 years, 30 years, 40 years. So it becomes very foolish to look at just what will be the impact of 1 month or 2 months and try to change the portfolio. A, it presumes that we can actually predict these things. Second, it presumes that we can keep rearranging our portfolio every day in the morning based on what we think. Neither of these is possible. So we do not approach it from that point of view. Our longer term thought process has not changed. There are certain areas where we think the opportunity in terms of valuations, structural growth remains attractive. We've talked about this in the past. Pharmaceutical, healthcare, automobiles, both have gone through some difficult times over the last 1, 2, 3, 4, 5 years. And now we are seeing some kind of repair. We like the longer term structural growth opportunity that these businesses have. So we tend to be positive about them. But again, at UTI, we don't have a one approach across all our funds. So you may find that funds have slightly different approaches in the way that they may be positioned in some of these sectors. Most importantly, just to repeat again, we are not trying to rearrange the portfolio holdings every day because of what we see in the newspaper about the second wave or otherwise. Let me also remind you, our portfolio turnover ratios at UTI are very low. Some of our strategies, many of our strategies have portfolio turnover ratios on a 12-month basis of less than 25%. We did not change their portfolios dramatically last year when the pandemic hit us and we never knew what the word pandemic meant. If we didn't do it, then why would we do a dramatic readjustment of portfolios today? Having said that, I think the one sector which is already showing the sort of uncertainty related to the second wave is the financial sector, because the automatic thought process is always that the banks could suffer if business doesn't take place and loans cannot be repaid. So though that is a sector which is experiencing the impact more in the very, very short term. But again, I think if you look at the quality of some of the companies in that sector, and I'm particularly referring only to the more companies with a higher quality there, if they have navigated the pandemic last year, I am willing to believe that they can navigate this second wave as well. And so we are, sort of bottom-up positive on some of the stronger names in that sector.
Thanks, Vetri. Since you stressed on financial sector, so I'll take this question, which is coming from Mr. Deepak Verma. So the question goes like this: it seems that most of the diversified equity funds in India have reduced its allocation to the financial services sector over the last few quarters, but still they continue to be the biggest allocation in many of the portfolios. So how is the growth path actually looking for the financial sector in the current scenario? So if you can detail a little bit on the sector, will help.
Sure. The reality is that financials are, depending on the benchmark you look at, they are 30 to 35% of the benchmark. And a large number of financial services companies are available in India, from NBFCs to microfinance companies to the banks with more retail, banks which are balanced between retail and wholesale. Then you have insurance companies, then you have the life insurance companies, you have general insurance companies, you have asset management companies. So, financial services encompasses a very wide range of companies. Some of them benefit from micro level growth, some of them benefit from structural trends, and some benefit from, the savings pool because their business models are related to the savings pool. So it's hard to generalize. But broadly, this is a sector that will continue to grow as the economy evolves, because financing is the growth engine of the economy. And as income levels go up, it creates demand for ancillary financial services and products. And therefore, we think this will remain a very integral part of portfolios because of the very nature of the service. Remember, India is still underpenetrated in terms of banking services and financial services, and certainly in terms of savings and wealth management oriented products. So there is a long runway for growth for this business in India, and therefore structurally we would remain positive on this sector. As regards loan losses, there are always cycles in the economy and that these institutions will undergo. We have to try and focus on those which are able to navigate the cycles better. Uh, you may have seen some funds reduce their exposure, but I think from a long-term structural point of view, you would want to participate in financial services in India for the reasons I mentioned.
Thanks, Vetri. There are questions on sectors like IT and pharma. Since these two sectors have actually done extremely well, the question is actually coming from Vikas Dubey, Krishnan, and Anand K. So, if you can uh, talk us through in terms of like how the pharma sector is expected to pan out from the current levels and also IT.
Sure. So when we talk about healthcare, I'll use the term healthcare. It actually is a wide range of companies. It's the pharmaceutical companies, it's hospitals, it's diagnostics, it's health insurance, that whole range of things. Now, when you think about that, the domestic pharmaceutical market and the domestic healthcare market is a fantastic long-term growth structural story. Why? Because unfortunately, as I mentioned this before, as incomes go up, stress levels go up, as pollution increases, more and more you see the rise of lifestyle diseases. What are lifestyle diseases? Diabetes, toxicology, cardiac conditions, central nervous conditions, where when you have medicines, they become medicines that you are going to have for a lifetime. It's not like an antibiotic which you have for 5 days and then you are done with the course. So as economies grow, this is a trend that we have seen, and therefore we think the domestic pharmaceutical market, drug market, will remain a strong growth opportunity. The export part of it, Indian companies are globally competitive. Yes, they did have issues in the last few years relating to quality, relating to pricing pressure in the US, but we think many of the companies have now addressed many of those challenges quite well. Managements are now a lot more focused on improving the ROC and ROE. So the whole sector has a wide range of opportunities. There are also contract manufacturing and research oriented companies which benefit from the fact that Indian companies are globally competitive in manufacturing and their chemistry skills. So that is the simple reason why we continue to like pharmaceuticals and healthcare. The sector is not as cheap as it used to be maybe a year ago, but given the structural growth over there, we still remain quite bullish about its prospects. As far as IT is concerned, once again, how many sectors in India have globally competitive companies, right? Literally, it is IT and pharmaceutical which lead the pack in terms of being globally competitive. One way or the other, we are now seeing a second wave of IT spending. In the US, many of the large IT companies are specifically referring to it as a strong increase in spending trends. So again, we think over there is some element of a cyclical uptrend in spending. The challenge perhaps in IT is that the valuations have moved to almost close to their 10-year highest that we have seen in terms of valuations. But simply from the competitiveness of those companies, and remember I mentioned that, one of the things we may experience in India is that because the developed world is likely to recover much faster, these globally competitive Indian companies who are primarily in servicing export, foreign clientele, either for drugs or for IT, are likely to benefit from the strength of those economies. So I think both these sectors remain strong, both from a top-down as well as bottom-up angle. Valuations perhaps slightly more in favor of pharma healthcare as compared to IT, but bottom-up, as I said, these are some of our strongest companies.
Thanks, Vetri. So, yeah, before I move to the questions on the funds, one last question on the sector. So, infrastructure as a space has actually garnered much attention post budget. So, can investors still look at this space, or do you think they should wait for an opportune moment?
So I still think the best period for India infrastructure was, a long time ago, right? That actually happened in the mid 2000s when we had a boom of infrastructure development, also aided by the whole PPP project. The reality, as I say today, is that nobody is interested in PPP projects anymore. Private capital, which went there, has had a bad experience. The banks that gave money have had a bad experience. And so the onus has fallen back on government to lead the way in terms of capex. Unfortunately, when you look at capex, Today, if you look at total capex by government, state, and center, right? 60% of the capex is done by state governments. Only 25% is done by the central government. The remaining 15% is done by the central government, but this is defense related spending. So, really, the governments which dominate capex in India over the last 10 years, over the last 20 years, the weight has moved more and more in favor of state governments. Unfortunately, the state governments are facing their own challenges right now in terms of their fiscal situation. So, I would still tend to be a little muted in my expectations of a significant improvement in capex. Yes, central government is doing a lot, but when you take the total mathematics, central government capex is only 25%, right? 60% is with the states, and they are not in very good financial health at this point of time. So, maybe from a valuation perspective, the some of the names in infrastructure might look more reasonable compared to where they were in the past, but this is not something that, as a theme, I would say is at the top of our mind at this point.
Thanks, Vetri. So the one question on again, we always end up actually answering this, which is on quality stocks versus value stocks. So yeah, so in this volatile scenario, especially which is coming out of COVID times, so where do you think the incremental allocation should go? A portfolio of quality stocks or the value stocks?
So my answer is the same as before. Unfortunately, most people look as quality and value as a way to do ki kishmis khaun ki kaju khaun, right? And you want to eat the kaju when you think kaju will do best, and then you want to shift to the kishmis when you think kishmis will do best. These cycles are very, very difficult to catch. Really, the way to think about it is that when you are allocating money to equity, you want to be invested in both quality and growth because the cycles will be different. And because the cycles are different, it will give you more diversity, more diversification within your overall allocation. Having said that, if you're looking for a thumb rule, the thumb rule is very simple. When markets are very, very cheap, that is the time where value actually tends to outperform growth over a medium to longer term period. Once the valuations reach more expensive territory, it actually becomes very difficult for value to outperform. Now, one of the unusual things which has happened in India, and this actually happened across the world, is that we have gone from a period of extremely cheap valuations to a period of very high, at least expensive valuations in a very short period of time. Literally, it has happened in 12 months. April 20, you were, two standard deviations below the long-term average in terms of price to book. May 21, you are one and a half standard deviations above the long-term average price to book. So the starting conditions today are not so favorable in terms of value vis-a-vis growth. I think today the equation is not so simple in terms of whether you should choose growth or value. And for value stocks, what becomes important is not just the fact that they are making good money today, but how much confidence do we have that they will continue to make these sort of record operating margins over a longer period of time. So today, I think, if anything, the argument is slightly more muted in terms of value after the strong run-up that we have seen, right? From the low point in terms of valuations in March 20 to today, in terms of where we are in terms of valuation, value has got that advantage. Can it sustain that advantage? I think that, to my mind, is a challenge.
Sure. The next question is coming from Mr. Anjan Maulik and also Rajeshwari Subramaniam Iyer. So it is on the market cap. So mid and small cap index has actually done well compared to the large caps over the last year. So is this equation expected to continue or change over next quarters?
So I think we've said this before, but to answer it again, when you are in a period where monetary policy is very, very accommodative, and in general, government policy is also very supportive of the economy, that is the best time for mid and small cap. And in a way, that is what we have seen now in terms of performance. From the low point, the mid and small cap has eventually ended up outperforming the large cap. What we should not forget once again is that these things are very, very cyclical. If you look at March, if you look at January 2018 to March 20, mid and small caps did horribly compared to the Nifty or to a select set of large cap stocks. Now from the low, mid and small is doing better. But when I showed those valuation charts, as I said, today you are sort of neutral in terms of the relative attractiveness. Mid cap maybe has a slight valuation discount, not so large to make you, feel thoroughly excited, but slight advantage is certainly there. So, to my mind, once again, what is relevant here is to be allocated across large, mid, and small rather than trying to play the cycle. The best time to play the cycle of going towards mid and small was actually 1 year ago when valuations were at a significant discount and the policy setting was just starting to turn favorable. Now you have already had 1 year of policy setting remaining favorable and you have had a big jump in valuation. So I would tend to be a little bit more muted in my aggression towards mid and small. But certainly, I think the market broadening that we have seen is likely to persist for some more time.
Sure, Vetri. So we are running out of time. So I'll take another two or three questions more.
Sure.
There is one question coming from Mr. Deepak Verma. So you touched upon unicorns of India in your initial remarks. So as we see some appetite among HNIs who are willing to get exposed to such ideas, so are there any strategies with UTI which captures the growth potential of emerging unicorns?
Yeah. See, investing in these sort of startup companies means that ideally you want to be running it like because these are unlisted. Remember, so you want to run it as a PE fund or a venture capital fund. Of course, UTI in the past used to have its own venture capital fund. We are not doing that at this point of time. If we do look at that in the future again to run a venture capital fund, at that point that would be an opportunity. But as a mutual fund house at this point of time, our strategies would look to participate in the company when it comes for a listing. We would not be investing in unlisted equity when they are still in the stage where they are developing an idea. Remember that, while unicorns do get created, the sort of mortality rate of startup companies is also very, very high, right? For every one Zomato which ends up creating significant amount of value, there are maybe 10 food delivery companies that went bankrupt. In fact, most people may not remember, but the company which actually started food delivery in India is now forgotten, which was a company called Food Panda, but it is forgotten, it is gone, right? The value got created in Zomato. So startups is that kind of a business. You maybe make 10 investment, one tends to be a blowout, two or three tend to be reasonable, and five or six go bankrupt. It's a completely different risk reward structure, does not lend itself to a mutual fund which provides daily NAV entry and exit, right? You need the structure of a VC fund where the money will get locked up for 7 years so that you stay locked up till such time that the company is able to, extract money by way of a listing or a secondary sale. So if we do launch a VC fund, we can consider it, but a mutual fund scheme which provides daily liquidity, we would not be making startup investments.
Yeah, sure, Vetri. That answers. It is believed that the dividend yield funds tend to do well in volatile or the bear markets, and they may underperform in secular or bull runs, right? So these funds have actually fairly done well, especially in the recent times, so where the markets are looming with more uncertainty. So according to you, what should be the investors' approach to dividend yield funds in today's scenario?
Sure. So I think the way to think about this is that typically you are right. When you look at dividend yield funds, and of course, at least we at UTI don't run the fund just on the basis of trying to buy the highest dividend yield companies. We are looking to buy companies which have a reasonably attractive dividend yield, but are capable of growing the dividend yield. Because if the dividend yield doesn't grow, it doesn't help, right? We have seen so many companies in the last 20 years where they appear to be high dividend yield, but what you realize later on is that that was just before the company eventually ends up going bankrupt or the business model suffers, and then it actually stops paying the dividend. So you are right in a sense, because we start by screening for companies which are reasonable dividend distributors. They don't tend to have very high investment needs, and they are capable, at least the way we look at it, for companies which are able to grow their dividends over time. So it tends to make the strategy a lot more stable. If you look at some of the sectors where we also have large exposure, both in the benchmark or in, for that matter, in our fund, you will see that a lot of exposure goes in those stable state, stable growth companies, which gives stability to the portfolio. So I would say it's really about getting a better risk adjusted return through lower volatility rather than a strategy which is willing to take on higher volatility and therefore higher returns. Risk adjusted returns could be better, particularly if you don't have the stomach for volatility.
Thanks, Vetri, for that apt answer. Since the valuations have actually reached the upper reaches, so is it advisable to increase the SIP amount or step up the SIP amount in equity-oriented mutual funds in the current scenario? Question is coming from Mr. Tirumani from Trichy.
No, I would say continue with the SIP, but no reason to really increase the SIP given that valuations are elevated. What you could do maybe separately is, if you have a lump sum that you are trying to invest, then maybe use a STP route, do a 12-month STP. And if at some point the market's actually correct, you could halt the STP and then consider whether you want to do a lump sum. But at this point of time, I would say just continue with the discipline of SIPs. Don't try to raise your aggregate exposure to equities because, in expensive territory, you do not try to raise your asset allocation. But if there is incremental investment you want to make, then you can look at the SIP or the STP.
Yeah, sure. And also, what is your what thoughts to the investors who are actually underweight in equity?
So that is more challenging. And unfortunately, I find that most investors are underinvested related to the target allocations that they need to achieve their financial goals. But it is still, it would not be appropriate to consider raising allocation when equities are in the expensive zone. So I would still say wait for your time. But I think it also requires some bit of mental preparation on the part of the investor, or more importantly, on the part of the advisor, because typically the cheap valuations come along with bad news, right? Last year in March, when the valuations were cheap, people may have said, oh, no, I don't want to invest now. I know valuations are cheap, but I don't know, maybe the world is coming to an end. Believe me, cheap valuations always come when you feel that, maybe the whole world is about to fall apart. So if you're able to mentally prepare yourself that when the market comes down, 20%, 30%, and believe me, in my career, 25 years, I have never seen a market where, at least every 2, 3, 4 years, it will correct at some point by 20%, 25%. So meanwhile, you continue the SIP, STP route. But when you get those big corrections, prepare yourself that when I see the prices come down, when I see news is bad, I will be having the courage to come ahead and actually increase my allocations.
Thanks, Vetri. So I'll take one last question, maybe two questions. So one question is coming from Mr. Sahil. So I'm an existing investor in Nifty 50 index fund. So would want to know how the stocks of Nifty 50 are different related to Nifty Next 50 from valuation and growth perspective.
So Nifty 50 is the top 50 stocks by market cap. The Nifty Next 50 is literally the next 50 stocks. If I remember right, if you look at it from a valuations perspective, the Nifty Next 50 has typically always been slightly costlier than the Nifty 50. One of the reasons for this is, remember, many of the high growth companies, as they are continuously increasing their market cap, many of them are passing through the Nifty Next 50 very often before they become candidates for the Nifty 50. So typically the Nifty Next 50, as I remember, has always been a little bit of a premium to the Nifty 50. But, that's just the historical relationship. So I'm not sure that by itself necessarily has an implication on the risk-reward ratio.
Thanks, Vetri. So one last question coming from Ashwin Pandya. So I'm looking for fixed monthly income from medium to long term. So which are the ideal category of funds to choose from?
So, honestly, I don't have a simple answer to that. You need to, first of all, identify whether you want to be in fixed income or whether you want to be in equity. One of the things that we have been highlighting to people is that if you want an income stream, one of the options you could consider is to look at some of the more sort of hybrid category of funds. And you can create your own income stream by using a systematic withdrawal plan. Literally, a systematic withdrawal plan is the opposite of the SIP. And rather than taking a dividend, which unfortunately increasingly is becoming very tax inefficient, it is actually more advantageous to take money out through SWP. So don't think of it as a yield instrument. Think of it as an instrument which allows you to gradually take out some installments on a monthly basis, which you can predefine the level of withdrawals that you would like to see. So consider a typically, I would say, a hybrid product, and you can execute a systematic withdrawal plan to create your own income stream. But again, you need to consult your financial advisor to see which product is relevant for you. But my main feedback would be consider the SWP as the appropriate method.
Yeah, thanks, Vetri. Due to paucity of time, sorry, we could not take many questions. So what we will do is we will forward the questions to our respective teams so that they can actually get in touch with you and answer them. So,
Sure.
so that's all from my side. Back to you. Thank you.
Great. Thank you so much, Niranjan, for taking us through all those questions. And thank you to all the viewers, both for joining us today and for sending in so many questions. It's your questions which make this more interactive and a useful session, not just for those who ask the questions, but even for perhaps others who may have had similar questions on their mind. So with that, we'll bring this session to a close. But once again, just prayers and good wishes for the health of all your near and dear, and let's continue to follow safe practices, and let's try to get vaccinated as and when the vaccinations open up. And the faster we can get vaccinated, the more we will be able to get back towards a world which resembles where we were prior to this pandemic 15 months ago. Thank you and take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.